Howdy, everybody. Welcome to Liberty Call. Today is Friday, July 5th, 2024. Hope you're having a fantastical day. Hope you had a good holiday yesterday. Mine was pretty good. Sat around, watched a lot of baseball, and did a whole lot of nothing, which was pretty nice. So my wife's still recovering from jet lag from spending 2 weeks in Italy, or the Mediterranean. And so we've been tired this last week. So it was nice to have a day just to sit around, do nothing. And the weather was beautiful here in Colorado. I don't think the highs got out of the 70s yesterday. It was like low 70s. So, I mean, it was chilly last night. So pretty nice. So hope you're having a good day. And, if you are working today, I mean, I've been doing a lot of like clerical type stuff around here, paying bills, doing letters, stuff like that. So pretty boring day in the markets, all in all. So didn't see a whole lot of headlines on the screen. They're talking about the election and boring stuff like that. So, all right. Well, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell because you want to know when I go live, because today might be the day I say something intelligent. I can't promise it, but today could be that day. All right, let's get into the indexes for today. The Dow Jones was up 0.17%, 67 points. It spent most of the day in the red. It closed at 39,375. The SP 500 was up 0.54%, closed at 55.66. NASDAQ up 0.9%, 163 points, closed at 18,351. The VIX was up today 1.22%, which is a little odd since the SP 500 was also up. The VIX was up 1.22%. It's at 1241. Canada down 0.83. Brazil up 0.11. And Mexico down 0.62. In Europe, Germany was up 0.06. The UK down 0.45. France down 0.26. The Netherlands down 0.11. Spain down 0.39. Italy down 0.35. Switzerland down 0.43. And Portugal down 0.04. So other than Germany, everybody else was in the red. I mean, granted, not by a whole lot. Everything was 0.5% or less. And headed over to the Russian exchanges. They were both in the green today. MOEX up 0.53 and RTSI up 0.51. And the overnights, the Nikkei in Japan was down 0.07, Australia down 0.12, New Zealand down 0.35. In China, the Shanghai was down 0.26, the Shenzhen Component up 0.25%, China A50 down 1.13%, DJ Shanghai down 0.12%, Hang Seng down 1.13%, and the Taiwan weighted up 0.14. So exciting stuff today in the markets. I know. All righty, well, let's bring up our weekly chart. Let me get that up on the screen here. Get that off. All right, here we go. Starting out with the Dow Jones. Starting out from Monday to today, the market is, the Dow is up 0.45%. The S&P 500 looks like it had a nice run this week, up about 1.83%. The NASDAQ, it's going to finish up 3.55%. Wow, that's pretty good. The Dow Utilities looks like it's going to finish in the red by 0.26. And the Dow Transports going to finish in the red down about 0.88. So all in all, not a terrible week. If we zoom out and let's put our trend lines back on there so we can see. Let's go back a couple years and take a peek and see what's been going on. So starting since really the back in 2020, we had the COVID crash, which only lasted a short bit of time because we printed the federal government and the Federal Reserve printed all that money. And then you had this nice rally, which lasted for, what was that about? How many months was that? Kind of peaked out at about 1.8 years. Was sideways most of 22 and 23. And at the end of last year, had a bit of a rally. I think that had to do with the expectation that we would start cutting rates, or the Fed would start cutting rates. And that hasn't occurred. So you can see we broke the trend line here that went into the early part of this year. That broke in about early February. Been sideways, had a little bit of an uptrend again. You can see that here by the bottoms and where they've been bouncing off this trend line. And, right now, my expectation is at some point we'll either break through this trend line or continue sideways until the Fed does something. So, all right. Well, those are our markets for the up through now. So, all right, let's get to the economic data that came out this week. We got a bunch of news. Initial jobless claims came in at 238,000. Forecast was 234. The previous week's number was 234. Continuing claims came in at 1.858 million. Forecast was 1.84 million, so about 18,000 over forecast. Previous number was 1.832, so up by about 26,000 there. The ISM Manufacturing Purchasing Managers Index came in at 48.5. Forecast was 49.2. Anytime it's below 50, that does show typically a contraction in the index, so that's not great. U.S. construction spending month over month contracted at 0.1%. The forecast was 0.3% growth, and the previous number was also 3% growth, or 0.3%. The JOLTs, Job Openings and Labor Turnover Survey, came in at 8.14 million jobs available out there in the market. Forecast was 7.96, and the previous number was 7.919. So that jumped up a little bit from the previous. And you can see since it peaked out at about, May of 22, it's been trending back down. Certainly not as, certainly not as low as the numbers pre-COVID, but that is what it is. Nonfarm payrolls came in at 206,000. Forecast was 191. The previous number was 218,000. And the unemployment rate crept up by 0.1% to 4.1%. Forecast was 4 even, and the previous number was 4% even. Labor participation rate ticked up a little bit to 62.6, right on forecast. The previous number was 62.5. And the U.S. trade balance contracted at is in a deficit of $75.1 billion. Forecast was 76.3, so a little better than forecast. And the previous number was negative 74.5, so a little worse than the last number. All right, so that's all the economic data that came out this week. Do you feel smarter? I know I do. Okay. All right, let's get to the market recap for today. The S&P 500 rides falling yields to record as rising unemployment stokes Fed cut bets. All right, the S&P 500 surged to a record high Friday, driven by gains in technology stocks as Treasury yields fell following a monthly jobs report indicating a cooling labor market. The report showed the economy added 206,000 jobs in June, down from 218 in May, with significant downward revisions for the previous months. The unemployment rate rose to 4.1% from 4% in May, and average hourly wage growth slowed, bolstering the case for a potential Federal Reserve rate cut in September. Macquarie noted that their base case for a rate cut is in December. An earlier reduction in September is increasingly likely. Consequently, traders now see a 70% chance of a rate cut in September, up from 60% the prior week. Tech stocks led the rally, with Meta Platforms rising over 4% to hit record highs, followed by gains in Alphabet, Microsoft, and Apple. However, NVIDIA Corporation saw a 1% decline after New Street Research downgraded the stock from buy to hold due to valuation concerns. Tesla stock rose 1% on reports that state-owned firms in Shanghai had purchased the Model Y as service cars following its addition to the local government purchase list. Macy's stock jumped over 9%, wow, after a report that Arkhouse Management and Brigade Capital Management had raised their bid to buy the department store chain for approximately $6.9 billion. Conversely, Chinese electric vehicle stocks, including Li Auto, NIO, and Xpeng, fell sharply after the European Union proposed increased tariffs on EVs imported from China. Cryptocurrency stocks such as MicroStrategy, Coinbase, and Riot Platforms also declined after Bitcoin fell to its lowest point since February. The drop followed news that the Mt. Gox exchange, which declared bankruptcy in 2014, had started making payments to creditors in Bitcoin and Bitcoin Cash, raising fears that creditors might sell their Bitcoins, potentially driving prices lower. In summary, while the tech sector strength propelled the S&P 500 to a new record, concerns about the labor market and mixed corporate news led to varied performances across different sectors. And for everyone out there, especially the people in finance, the financial journalists who have been just begging and pleading, wishing it into existence that the Fed would lower rates sooner than later. See, here's the thing. This is my personal hypothesis: is that the Fed's not going to do anything until there's a reason. And usually, those reasons are the market's crashing, the economy's crashing, the job market's crashing, and they usually all kind of fall together. So, for all these people who think, well, when the Fed lowers rates, that's going to be a boost to the stock market. Odds are the stock market's not going to be performing that well because of all the other things around it that are going to be doing poorly, like spending is down, and unemployment is going to be rising because receivables are lower, or profits are down, and we're having to cut headcount. So that's going to be less people employed, which is going to reduce spending even more, which again creates that vicious cycle. All righty. Well, let's get to some data here, or the June employment report. This comes from Robert Stein, Deputy Chief Economist at First Trust. See what he said. Despite a headline payroll increase of 206,000 in June, signs indicate the job market is decelerating. Revisions for prior months reduced recent payroll gains by 111,000. In the private sector, payrolls increased by 136,000 in June, but were revised down by 86,000 in previous months, resulting in a net gain of only 50,000. Civilian employment, which includes small business startups, rose by 116,000 in June, but has increased by only 195,000 jobs in the past year. Consequently, the unemployment rate has risen to 4.1% from 3.6% a year ago. The household survey reveals a decline of 1.55 million full-time jobs compared to a year ago, with all job gains occurring among part-time workers. It is also taking longer for unemployed workers to find new jobs, with the median duration of unemployment rising to 9.8 weeks in June, the highest since January of 2023, compared to 8.8 weeks in June of 2023. The increase aligns with recent rises in continuing job claims, excluding government jobs, education and health services due to their structural and demographic growth, and leisure and hospitality still recovering from the COVID-19 lockdowns. The core measure of payrolls rose only by 46,000 jobs in June, slower than the average of approximately 70,000 per month in the first half of the year. Wage growth continues, but at a slower pace, with average hourly earnings increasing by 0.3% in June, up 3.9% from a year ago. This is a decrease from the 4.7% increase observed in June of last year. The Federal Reserve likely aims for wage growth around 3.5%, considering its 2% inflation target and a 1.5% productivity growth per year. And the current figures are approaching this goal. However, monetary policy tight enough to meet the Fed's inflation goal may further slow the economy in the coming months. All right. Good stuff. All righty. One last article here before we finish out the week. This comes from Zero Hedge. June jobless rate triggers the Sahm rule. Recession imminent. Woo. That's not some good news there. This morning's U.S. Bureau of Labor Statistics data release showed an increase in the U3 unemployment rate to 4.1%. in June of 2024, slightly above the forecast rate. The U3 measures the percentage of civilian labor force that is jobless, actively seeking work, and available for work, excluding discouraged workers and the underemployed. This uptick triggers the Sahm rule, a real-time recession indicator suggesting that the U.S. economy is in or nearing a recession. The Sahm rule, developed by former Fed economist Claudia Sahm, identifies the start of a recession using changes in the total unemployment rate. According to the rule, a recession is underway if the 3-month moving average of the national unemployment rate rises by 0.5 percentage points, or more relative to its low during the previous 12 months. With the June 2024 U3 rate at 4.1%, the average of the last 3 months being 4%, and the lowest 12-month rate of 3.5% in July of 2023, this criterion has been met. The U3 rate was expected to remain steady at 4% in June, unchanged from May of 2024. This seemingly small 0.1% uptick, however, carries substantial implications for the broader economy. One possible confounding effect of this signal is growth in the labor force. If the labor force grows rapidly and the economy does not generate enough jobs to match this increase, the unemployment rate might rise, triggering the Sahm rule, even if overall employment is increasing. The rise of initial claims over the past few weeks and nine consecutive increases in continuing claims support the June 2024 Sahm indication. Equity futures were flat just after the release, while treasuries rallied across all maturities. In recent months, Fed Chairman Jerome Powell has indicated that unexpected weakness may prompt a shift to accommodative policy stance without additional data regarding the pace of disinflation. Historically, an increase in the unemployment rate and the onset of a recession have led to policy adjustments aimed at stimulating economic growth and mitigating job losses. The anticipated reversal of rate hikes, which began in 2022 to mitigate the highest inflation in 4 decades, may soon be on the horizon. While more data is needed to confirm the Sahm rule indication, the impact of accelerating prices, higher interest rates, and commercially suppressive pandemic policies have likely caught up with U.S. producers and consumers. Awesome news, isn't it, folks? Well, there's just another little bit of data along with all the stuff that I cover on a daily basis, which, it's all those little indexes and indices and things that the Fed looks at that especially services growth and services spending and construction and all those sorts of subcategories of the economy. Day to day, they don't look that great. If you look at the 30,000, the macro level, unemployment, 4%, 4.1, looks pretty good. Consumer spending still trending up. So if you just look at those numbers, you say, hey, the economy looks great. What's everyone complaining about? We should probably, lower rates, make it more accommodative for people to borrow money at, lower, at little to no interest. So anyways, all right. Well, that is all I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. If you need to get your financial crap back in shape and prepare for whatever is in front of us here in the near future, give me a call, shoot me an email. Be happy to help you get your finances back on track. All right. Well, that's everything I had for today. So if anyone, like I said, needs anything from me, go to my website. Otherwise, have a terrific weekend, and I shall talk to everyone again next time. Adios.